Welcome back to week 3, part 2, here in Finance 4324, Commercial Bank Management. In this segment, we're going behind the scenes into how banks really make money and how they measure whether they're doing a good job. Spoiler alert, it's not just about making loans and collecting interest. Think of it like your own budget. You've got your paycheck. That's like a bank's loan income. You've got stuff you can't avoid like rent, groceries, and gas. Those are the bank's expenses. And then you've got the things that sneak up on you. Late fees, overdrafts, parking tickets, and those streaming subscriptions you keep forgetting to cancel. Banks are no different. They survive on a messy balance of interest, non-interest income, and how efficiently they juggle it all. Banks love their fees the way coffee shops love extra shots of espresso. Every overdraft, ATM surcharge, or wire transfer, it all adds up. Sure, it might feel like nickels and dimes to you and me, but when millions of customers are all paying those nickels and dimes, that's billions in non-interest income. The lesson here: interest income may be the juicy double cheeseburger, but fees are the fries on the side, and nobody orders a burger without fries. So how do banks decide what to charge? It's not random. Consider cost plus pricing. Imagine you run a food truck. You add up the cost of ingredients, the gas to keep the truck running, the permit fees, and then tack on a little bit of profit. Banks do the same thing when they set up checking accounts or savings products. That's why you see minimum balance requirements or monthly service charges. From the customer's side, it can feel a bit like being charged just to breathe the air. From the bank side, it's just making sure that the math works. Deposit service charges. This is the part you have probably felt firsthand. Bounce a check, pay a non-sufficient funds fee. Swipe your debit card when the account's empty, overdraft fee. Use an ATM that doesn't belong to your bank's network. That'll be $3, please. Individually, these charges may look small, but across millions of accounts, they're like that one friend who always forgets to Venmo you. After a while, it all begins to add up. Transaction account fees. This brings us to conditional pricing. Don't keep enough money in your account? Fee. Make too many withdrawals? Fee. Cash out your CD before it matures? Definitely a fee. It's not just punishment, it's behavior management. Banks want predictable customers, and fees are their way of nudging people into line. Now let's zoom out to the business world. Think of a small business owner who sells online. They don't have time to run to the bank every day with deposits, so the bank gives them remote deposit capture. Scan the check, and money goes in. Or a big employer that runs a payroll for thousands of employees every 2 weeks. They lean on ACH transfers and direct deposit. All those services come with a price tag, and businesses are willing to pay because it saves them headaches. For the bank, This is no longer nickels and dimes. This is serious money. The kind of fees that keep balance sheets healthy when interest income begins to wobble. Wealth management fees. Wealth management is where banks really flex their muscles. Personal trust services, retirement planning, custody of assets, investment management, all of these are fee-based. Sometimes this division alone makes up a quarter of the bank's total net income. Think of it as banks getting paid for their brains instead of their vaults. Clients pay for expertise, not just transactions. It's advice, strategy, and security all rolled into one. Of course, banks have expenses too. These are the non-interest expenses, the cost of doing business. Salaries and benefits top the list, often eating up 40% or more. Then come IT systems, branch upkeep, marketing, and advertising. Picture your own life. Your paycheck comes in. Rent, utilities, internet, and maybe a car payment go out. That's your non-discretionary spending. Cut too deep and you're going to be very uncomfortable. Spend a little too freely and then you're broke. Banks walk that same tightrope. Bank expenses. IT costs cover servers, software, cybersecurity, ATMs, and all the plumbing that keeps the system running. Branch costs include maintenance, landscaping, utilities, and then there's advertising, billboards, radio spots, TikTok ads. And then, of course, there are salaries. Banks can't ignore these, but they can manage them smartly. Just like you decide whether to cook at home or maybe hit DoorDash again, banks decide how to balance cost versus convenience. Chapter 11, How to Measure Bank Performance. How do we know if a bank is doing well? This brings us to the concept of performance ratios. They're kind of like a financial report card showing how profitable, efficient, safe, and competitive the bank really is. Financial performance ratios. Profitability. Profitability ratios. Return on assets, for example, measures how well management turns assets into earnings. Return on equity, ROE, shows what shareholders get for their investment. Net interest margin, or NIM, is the spread between interest earned and interest paid, scaled to assets. And then there's the efficiency ratio. How many cents it costs the bank to earn $1 of revenue. Tip: lower is better. Think of ROA as your GPA, return on equity as the reputation you earn in your field, and the efficiency ratio as how many hours of work you need to pay your rent. The lower the hours, the better you are managing. More financial performance ratios, in particular risk and capital ratios. Profit is nice, but safety is non-negotiable. Asset quality ratios track loan losses. The Texas ratio, for example, looks at how well capital covers non-performing loans. Liquidity ratios, LCR and NSFR, show whether the bank can survive a funding crunch. Capital adequacy ratios, especially Tier 1, measure whether the bank has enough cushion to absorb shocks. These are the stress test numbers regulators actually care about. As students, think of them like your emergency fund. You might be earning money at a job, but if you've got no buffer for car repairs or medical bills, you're one crisis away from trouble. Banks are the same. Peer analysis. No bank operates in a vacuum. They compare themselves against peer groups of similar size and scope. But why? Because context matters. If your efficiency ratio is 70% and your peers average 55, that's a red flag. If your net interest margin is higher than the group, that's a competitive edge. It's like comparing your GPA or intern experience to a classmate in your program. Without context, you don't know if you're ahead, behind, or right in the middle of the pack. Earnings releases. Every quarter, banks step into the spotlight with what's called an earnings release. Think of it as the bank's version of a group project presentation. Everyone has a role, the audience is judging, and there is nowhere to hide. The CEO kicks things off, giving the big picture story. The chief financial officer jumps in with the numbers, and you had better believe investors hang on every decimal point. The chief lending officer explains how loans are performing, and the chief risk officer reassures everyone that the bank is not about to topple over. This isn't just a polite update. It's live, it's public, and analysts are waiting with questions. Imagine standing in front of your class while everyone quizzes you on why your group project went sideways. Except in this case, the stakes are billions of dollars and the future of the bank's stock price. The purpose is straightforward. Deliver results, answer questions, and shape the story so the market walks away feeling confident. Because in banking, confidence isn't just nice to have, it's as critical as oxygen. So why do banks even bother with an earnings release? Simple. They need to tell a story. And not just any story. One that convinces investors, regulators, and analysts that the bank knows what it's doing. First, it's about painting a clear picture of the financial outcome. Imagine turning in your semester grades. You don't just hand over the GPA, you show the classes, the credit hours, and the trends. Same is true with a bank. They highlight the key ratios and show what's up and what's down. Second, they explain the rationale. Investors don't just want to hear what happened, they also want to know why. Did loan growth stall because of the economy? Did expenses rise because of new tech investments? It's the bank's chance to say, here's the reason behind our numbers. And finally, they have to handle live questions. That's the hot seat. Analysts can be like professors grilling you during an oral exam. Why did margins fall? What are you doing about credit risk? The job of management is to answer with confidence and spin those answers into the most positive outlook possible. At the end of the day, the purpose of the release isn't just about reporting results. It's also about managing perception. It's about telling the bank's story in a way that builds trust, even if the numbers are not exactly perfect. Goals of the earnings release. The goals are simple: explain performance, instill confidence, highlight big initiatives, and yes, maybe even nudge the stock price a little bit higher. But beyond Wall Street, it's about telling a story. Numbers without context don't inspire trust. A narrative that connects ratios to the real story does. Keep this in mind the next time you are writing an essay or completing a homework assignment that requires you to compute ratios or other formulas. Numbers without context don't mean very much. A descriptive narrative that ties those numbers to other facts, strategies, or decision processes does. Key components of the earnings report. So what exactly goes into an earnings report anyway? It's not a mystery novel, but it does have a formula. First up are quarterly highlights. These are the bullets everyone looks for. The ratios, the growth numbers, what went up, what went down. Think of it like the grade summary at the end of your semester. You don't list every assignment, you show the final average, the GPA, maybe a professor's note if something unusual happened. That's what the CEO does. Stands up and says, here's how we did, here's how it ties back to our goals, and here is why any of that matters. Then you get to operating performance. That's the chief financial officer's territory. Picture someone scrolling through the balance sheet and the income statement, calling out percent changes, ratios, and year-over-year trends. It's not flashy, it's not sexy, but it's where the truth lives. Numbers do not sugarcoat. If expenses spiked or revenue dipped, it shows up here. The bottom line, these components give investors the snapshot they need. Not every detail, but enough to answer the big questions. Are things trending up? Are they trending down? And does management sound like they know what they're doing? More key components of the report. If quarterly highlights and operating performance are the appetizer, this is the main course. These are the deep dives where analysts really sharpen their pencils. First, the loan portfolio analysis. This is where the chief lending officer explains what's inside the loan book, the mix of mortgages, business loans, consumer credit, and more importantly, how healthy they are. Asset quality and charge-offs are the red flags here. If too many loans are going bad, investors begin asking if management's asleep at the wheel. Next, the deposit portfolio. This is all about where the money's coming from to fund those loans. Are deposits stable? Are they expensive to maintain? A chief financial officer or chief deposit officer will break down the composition and the expenses. It's like checking your paycheck. Steady income means you can plan ahead, but if it's spotty or costly, there's probably trouble brewing. And then we get to capital management. This is where the chief risk officer gets to shine. Capital ratios tell the world whether the bank has enough cushion to handle a storm. Think of it like your emergency savings. No one brags about having it, but when the car breaks down or the roof leaks, It's the only thing keeping you out of financial disaster. These three pieces, loans, deposits, and capital, are the guts of the bank's operation. Together, they tell you whether the bank's balance sheet is built on solid ground or loosely constructed on a pile of sand. So, to wrap things up, banks earn through fees and interest, they spend through discretionary costs, and they prove themselves through performance ratios and earnings calls. Here's the big takeaway from all this. Don't just memorize formulas. Ask yourself what the numbers really mean. What story are they telling about profitability, efficiency, safety, and competition? This is how you move beyond being a student of finance and instead graduate to being a professional who can easily read between the lines. See you online.